Okay, meantime, more corporates right here on Market Cafe. The management of TCIL is joining us now to talk about the Q2 numbers. Remember that the revenues had grown by a good 15.5%, margins was absolutely stable, and the net profits had shown a growth of about 30%. Vineet Agarwal, the MD of TCIL, now joins us on the show. Mr. Agarwal, thanks so much for joining us on ET Now. To start with, if you could just explain to us, what was the volume growth across segments, supply chain, coastal shipping as well?
So for us, the volume growth is not really decipherable by tonnage, but because we move not just tonnage, but let's say we move cars and two-wheelers, or we move containers. So it's all varied across all divisions. But predominantly, we are saying that there has been at least a 5 to 10% volume growth across all sectors. In some areas, like auto logistics, is perhaps more than 20%. But overall, there's also been some value growth, and combined both of these, you've seen that the first half of the year we've had a total revenue growth of about 16%. So it's a combination of various factors and not just one factor.
Could you also tell us how is trade and freight traffic looking like at the start of Q3? And also at halfway mark, what volume growth are you penciling in for the entire year?
So several factors. One is that the fact that GST is stabilizing to a great extent. Then secondly, the end of the year, end of the calendar year, December is typically when MNCs close their books. So we see a lot of volume push at that point in time. And then the third other trigger is essentially the March end, when the Indian companies are closing their books, and again there's a push towards volume. So typically the second half of the year has always been better for us, and what we are trending towards is the higher teens in terms of growth rates. We did about 16%, so I think more the 20+% range in the next these 6 months. So several factors, the GST being actually quite underlying there. Transit movement between the states, the traffic, etc., has not improved too much. Some checkposts have disappeared, but that doesn't mean that the overall volumes movement is become smoother. But there is volume growth, there is some sentiment improvement, and consumption trends also high. So when we see e-commerce companies or we see the other FMCG companies, there is some amount of volume movement as well.
And how much benefit will you see post-GST on tax front versus the earlier effective rate? And do you see a scope for revising prices post-consolidation in the sector?
So tax rate from our perspective has actually been a little bit of a disconcerting in many ways, because earlier we used to pay a single service tax. Now, and that used to be roughly about 6 returns every quarter. Now we are actually filing 180 returns every month because handling charges take 18% GST charges, container transport is a different rate, road transport is a different rate, warehousing services are a different rate. So each segment will have its own issues in terms of how we get a certain amount of benefit. But overall, as an organization, these changes in these tax rates will actually be neutral for us. We will increase certain level of compliance clearly, so that's additional cost, and that will get offset by certain benefits. So in reality, that is not going to have a major impact on us. However, what will happen is that the overall rationalization and the overall impact on other companies will have a better impact on us. So I do not foresee any reduction in pricing for the time being, but I do see efficiencies coming in over time, and that could translate into some level of sharing of profits between companies that we work with very closely.
Okay, Mr. Agarwal, thanks a lot for taking time out and talking to us about the growth plan ahead.